In the summer of 2012, the economy just wasn't growing as fast as we thought it should. The unemployment rate was 8.1%. It had been elevated at quite high levels for much too long, and we needed to jumpstart the economy. So we announced in September that we were going to do open-ended asset purchases. So we were just going to keep doing it until the economy improved, until we saw a substantial improvement in the labor market outcome. I think it worked. It took a little bit longer than we thought. It was always intended to be temporary, but we're still purchasing assets right now. Financing costs declined, mortgage rates declined, and we had a lot of auto sales and increased home purchases in the U.S., and so that really helped a lot. I think that the volatility that might have been engendered last year when Chairman Bernanke started talking about this gave way to a clearer understanding of what we really intended, and now markets have digested this pretty well. I think we're on a good path. Well, I think it's very important that we continue with our strongly accommodative stance. I think the economic conditions demand that in the U.S. And inflation is low. It's too low. It's 1% in the U.S. Our target's 2%. We're not really accustomed to having to deal with too low inflation, and countries that have had to deal with that have had particularly difficult experiences. So we want to make sure we get inflation up to our target, which is 2%, and that's going to require continued accommodation well into 2015, I would say. I kind of think that the key indicator is going to be inflation. Right now, my inflation expectation for 2016 is that I'm hopeful that it will be as high as 1.75%. That'll still be below our 2% target. We'll have been below 2% for quite a number of years. That's not what we want. So if inflation doesn't move up, we're going to have to do this even longer. That seems reasonable. In fact, if I had my druthers, I would keep interest rates at zero for even longer than that, because I think that would be appropriate. What's really going to be important is understanding the path of increases. Just because we start increasing doesn't mean we're all of a sudden going to get to a high nominal interest rate. So our most recent FOMC statement indicated that we're expecting this to be a shallow increase in interest rates. That'll continue to provide strong accommodation for quite a long time. Well, we're talking about future actions, and so people have to expect that we're going to take these actions. We have to describe it, or else they won't have the faintest idea what we really intend to do. So it's first order that we go out and communicate very clearly the types of data that we're looking at, our intentions, and that we follow through with it. And we have to constantly communicate to people that we're going to hit our goals. We're going to get inflation to 2%. We're going to get unemployment to the sustainable rate, which is 5.25%. And when we're not meeting those goals, we're going to work hard to get there as quickly as we can. I'm hoping that it's going to go back to the old days where the short-term policy rates are closer to 4%, and if there's any difficulty, we reduce the interest rate just a little bit, half a point maybe. If things are inflationary, we increase interest rates, half a point maybe, something far less volatile than what we've seen from policy. We need to get back to normal times so that we're not doing these extraordinary policies. But we have to have the economy that warrants that.